Hi folks, this is Sean Hyman from Chart of the Day, and I want to talk to you about the predictability of ranges. Here we see a technical range. Let me actually back up. This was an uptrend that started consolidating into a range, and we start to really see the range form when we get here. You know, your highs here really aren't higher than these highs. Your lows here really aren't lower than these lows. And so you don't have decisive higher lows and higher highs. You do not have. You also do not have lower highs and lower lows. You've actually got a combination of them both. So what that means is these things are squeezing tighter and tighter. The volatility is getting closer and closer together, forming a triangular sideways range. So it's sideways because we're not really getting anywhere. You could ask a 12-year-old, you know, where is this thing going? They'll tell you nowhere fast. But when the move is like this, it's notably higher highs and higher lows. When the move is like this, it's notably, you know, lower highs and lower lows. But in here, we just have this consolidation. And these can be great plays. They don't happen often in the type of environments that we're in. But lately, with the consolidation in stocks that we've seen, it's producing a consolidation in some of these yen crosses, most notably the euro yen. And so if stocks start to crumble like I think that they will, we will eventually see a downside break out of this as money runs away from the riskier asset, which would be the euro, the higher yielding of the two, and it would run to the defensive asset, the Japanese yen, the lower yielding of the two, you know, the one that's been sold off the most and beaten down the most in this whole thing. Because in all of this, the euro has risen more than the yen, and that's why the pair has gone up. However, if a bunch of mayhem unfolds again and we get the onslaught that we saw in the past recession and bear market, like I think that we'll see again, then the pair will eventually break to the downside. So when you're trading ranges, it's good to keep the path that the future direction could, you know, potentially take into consideration, because that will have you shorting rallies. That way, if you got a breakout, it continues on and breaks on down, and you make even greater profits. But if you were to buy near the bottom, and if my scenario is right, and it were eventually break through the bottom, then you would have a higher chance of a losing trade. So technically, within a range, you can always buy a bottom, you can sell short a top, or buy at the bottom, sell the top, then sell short at the top and buy at the bottom. However, I do encourage you to think about the potential outcome. The fundamentals eroding in the U.S., which will cause money to erode away from riskier assets as stocks crumble. If the scenario unfolds, then your higher probability break is to the downside. So your risk would be more so in buying the dip here than it would be selling short the rally. So right now we're here in the middle of the range, so it's not trade time yet. When it gets to the edges is when you get the high risk to reward ratios, because if we were wrong in this trade on the short, we would know it by the time it got up in here. So we've got, say, this much risk in the trade, but if we're right, we can short and have all this for potential profit. So a little bit of risk and a whole lot of reward, and that's the scenario that we want to see, and that's why you want to short near resistance. Thanks so much for attending the chart of the day, and look forward to seeing you tomorrow. Bye-bye.